Welcome back. Hope you're doing well. Over the last few sessions, you have a very good understanding of the basic financial statements in a company. You've also looked at some complex, sophisticated expense items and revenue items and how each of these are recognized. And you also very briefly know how to analyze these three financial statements. What we're going to do in this class is actually take all these three financial statements, the balance sheet, the income statement, and the cash flow statement, and we're actually going to bring it together in what is popularly called in the finance industry as a three-statement model. We are going to build all these three financial statements together as one entity so that you know how any adjustment or any entry in one statement affects the state of affairs in the other statement. And the reason we are doing this is because this is exactly what you're going to be called to do as as a corporate finance manager or a senior executive, a C-level executive in a big company. You probably have to read these three statements. So it's going to be really helpful if you understand how these statements are put together. Okay, we're going to dive right into this. And what I've done is I've already set this up at a very basic level for you. The first thing here, this is the balance sheet. We're going to do it for July and August. The second statement you see here, this is the cash flow, and again it's for July and August. And the third statement you see here is the income statement, and again, once again, for July and August. Okay, so and one of the other important things we're going to bring back here that you actually saw in the first session, the life cycle of the company. You remember how we said corporate finance is all about making objective database decisions at each period of the life cycle of the company. You're going to see how that happens here. So let's say a company starts off, okay, and how does a company start off? The promoters probably invest some cash in the company, okay. So cash, let's say the promoters invest, what do we say? We want to say the promoters invest 5 lakh rupees in the company, okay, in cash the promoters invest. And what is that? That is an asset, right? Cash is an asset. So we'll name these things as we go. So I'm going to do this on the fly. So now if cash went up by 5 lakhs, what is the proportional increase in the balance sheet? You remember a balance sheet has to balance. So what is the proportional increase? It is the shareholders' equity is the proportional increase that goes up by 5 lakhs, because on day one, if the starting cash balance in July is 5 lakhs, that's all the shareholders have is a 5 lakhs, and that is it. Are there any changes in the income statement? No, right? Money has been just invested in the company. There has been no operations and none of that. There's really no changes in the income statement. Because of that, there's going to be really no changes in the cash flow statement because money has gone in and that is the end balance, so nothing has happened. So there's nothing happening in the cash flow statement. So and let's see what happens after you invest money. What do you start doing in a business? And let's go back to our favorite pizza company. You're starting off your own small pizza and pasta joint near your house in your neighborhood, and you put 5 lakhs in the company. What do you do next? You start buying your ovens and furniture to set up your restaurant. You start hiring a couple of people to make your pizzas and all that. So those are expenses in July, right? The first expense you're going to have, let's say, is you're going to buy furniture. Okay, and the furniture is so that your restaurant looks nice and sophisticated and all that, and you are spending 1 lakh in furniture. Now we're gonna make the matching accounts as we go on and not at the end of the time. So if you spend 1 lakh in furniture, what is happening? Where's that 1 lakh coming from? That 1 lakh is coming from your cash balance, right? So at the end of that transaction in July, your cash balance is that 5 lakhs minus this 1 lakh. So your cash just came down by 1 lakh, so your cash balance is 4 lakhs. And typically, this is what your shareholders' equity would come down by 1 lakh. So rather than just balancing the balance sheet as we go, what I'm just going to do is I'm going to say total assets here. Okay, total assets. Okay, and I'm gonna sum it up, the total assets. Oops, it's going to be I added the ending cash and the beginning cash, right? You wish you had all that free money, but no, that's the total assets. And we're gonna have something here saying liabilities, and we're gonna have we're gonna put this, and we're gonna say total liabilities. Okay, total liabilities is going to be the sum of whatever we added here, right? And you all know shareholders' equity is really nothing but your total assets minus your total liabilities is shareholders' equity, right? You're familiar with that formula by now, okay? So there we go. So what happened here? Your furniture 1 lakh, cash went down by 1 lakh, so your assets it's 4 lakhs, so your shareholders' equity is 4 lakhs. Now let's say you buy you buy a oven. You have to buy a pizza oven, okay? And what happens? Let's say the pizza oven is another 1 lakh, and there you go. So what happens here again? Your cash balance goes down by another 1 lakh. Is that all that happens? There is something. If you are paying attention into this, you probably realize we missed doing something with furniture. Furniture is a long-term asset. The value of the furniture is over a period of time. Similarly for a pizza oven. So we are supposed to capitalize these expenses. We are not supposed to put down these expenses as 1 lakh in the first year itself, right? You remember that, right? So we're gonna go here to the balance sheet, and we're gonna say capex, and the capex of the furniture, I'm just gonna write this in short form, all right? Furniture and oven is how much? 1 lakh plus this 1 lakh that's your furniture and your oven, 2 lakhs in capex. Now here what are we going to do? Are we going to record this entire 1 lakh and 1 lakh as cost here? Not really. We're going to say this furniture, hold on, let me just write, that's 2 lakhs, okay? Since we're going to say, since this furniture, we're going to amortize this over, depreciate it over 2 years, which is 24 months. So, and this is a monthly income statement. So the cost of the furniture divided by 24 months. We divided that by 24 months. So the monthly depreciation for that furniture is going to be 4,167. Similarly, we're going to do that for the pizza oven as well, and that's the monthly depreciation. So in this month of July, all we are doing is we are spending money setting up the whole restaurant. So we have no revenue. These are our operating expenses, okay, and then you have operating income. All right, there we have it. So and let's say in this month you also spend money on marketing. You're printing some flyers and you're making some initial investment in marketing. You're spending 50,000 rupees in marketing. Okay, so now that 50,000 rupees, what is going to happen? That 50,000 rupees is going to come out of this ending cash balance. So the cash balance started with 5 lakhs. From there you subtracted you know what, let's just subtract 1 lakh for the furniture. You subtract another 1 lakh for the pizza oven, all right, and because you spent that much money, even though you're depreciating only 4,000 rupees, and then from there you subtract the marketing cost, which is not depreciated, it's an operating expense for that month. You subtract all that, and that's how much your cash is left. 2,50,000 rupees is your cash balance. Now what you do is, what is your operating income for this year? Your revenue minus your operating expenses is that you're making no operating income. You're actually making a loss of 58,333 rupees, and that's completely fine because you're just investing in the business. So let's make sure we capture all this here in the balance sheet. 5 lakhs starting cash, you subtracted your oven, you subtracted your furniture, and you subtracted your marketing cost. That's your ending balance. This is the capitalized value of your oven and your furniture. That's 2 lakhs. So your total assets is nothing but your ending cash balance plus your capital expenditure. That's 4,50,000. Okay. So now let's go to the and since obviously there's no liabilities, your net shareholders equity is the same amount as your total assets. Now let's go to the cash flow statement. You remember a cash flow statement is supposed to reconcile how did this 5 lakhs become, how did this 5 lakhs become 2.5 lakhs. So what is the first thing that we add to a cash flow statement? Net income, or in this case we're gonna add the operating income, because that is the cash that's coming into the company. In this case, it's actually cash leaving the company. So 58,333 is leaving the company. And is that all the cash that's leaving the company? No, right? You look at the balance sheet, you realize you've spent 2 lakhs buying buying your furniture and pizza. So you're gonna say capex, and that's what that investment is called if you remember. Capex is 2 lakhs, and it's not plus 2 lakhs. Cash is leaving the company, so it's actually minus 2 lakhs. Cash is leaving the company. Operating income again is negative, that's why it's minus. Now there's one final thing you have to do. Now on your income statement you have these 2 expenses, 4,167, 4,167. Those are non-cash expenses because they are depreciation. You know, the cash is being paid. This is just the residual value that's being depreciated. So you're going to go back here and add a line in the cash flow statement called depreciation, and you're going to add back the depreciation expense, because right here when you said negative 58,000 rupees is operating income, that assumed that these are cash expenses. Since these are not cash expenses, and since you're building a cash flow statement, you need to back them out so that this always is only cash inflows or outflows. So let us see what is the sum of all this. Okay, there we go. 2,50,000 right there. That's your ending cash balance, and you see it matches the balance sheet number of 2,50,000. That is it. That is the work of a cash flow statement. So you saw now how when cash entered the company here, what happened in the balance sheet, and then how when cash was spent on an income statement, what happened on the balance sheet, how it got capitalized, how it got depreciated, and finally how the cash flow statement reconciled the difference between the starting cash and the ending cash. Now what we're going to do is we're going to go into August, and August is like, you know, you've launched the product, and in August you make a revenue of 2 lakh. Okay, August is a great year, you make a revenue of 2 lakhs. You're not going to spend any new money on furniture, but the depreciation stays the same. You remember that, right? Because the depreciation stays the same because it's monthly depreciation, so it's the same amount of depreciation. Let's say you're going to spend 1 lakh on marketing, and let's say you're going to pay some salaries this month, another 1 lakh. Actually, you know what, you'll make a loss then. Let's say you're going to pay 30,000 in salaries. So what is your operating expense, your operating income for this year? August, it's actually 61,000. So in July you had a loss of 58,000. In August you turned a profit of 61,667. Now we did all this quickly. Let's go in and see what's going to happen to the balance sheet. Now the first thing, right, what is your starting cash balance in August? Your starting cash balance in August is nothing but your ending cash balance in July, which is 2,50,000 rupees, because what cash you had left over on July 31st night is going to be the cash you're going to have when you wake up on August 1st the next day morning, which is why the August cash balance is the same as the ending balance of the previous month. And what's happening here? We have to calculate the ending cash balances. Where has money been spent? Money has been spent on furniture and pizza oven? No. Furniture and pizza oven, you spent the money the previous month, you're spending no money. This is just depreciation, non-cash expense, no cash is going out. You spend 1 lakh in marketing, that is cash went out of the door. So you subtract that from 2,50,000. Where else did you spend money? You spend another 30,000 rupees on salaries. You subtract that as well, cash going out of the door. You're left with 1,20,000. Now let's come to your capex. Are you making any new capital expenditure in August? No, right? You didn't buy any new furniture or pizza oven. But however, the value of your furniture and your pizza oven is not 2 lakhs anymore. Because you depreciated it, you're going to subtract the sum of the depreciation in the previous month to the original value of your asset. So the new value of your asset is only 1,91,667. And that's your total assets. You have no liabilities yet, and your shareholders' equity is essentially your total assets right now because you have no liabilities. Now, are we all done here? No, we're not all done, because not only did you spend cash in August, you actually got some cash into the company, right? You got revenue, so you actually got this cash into the company, yeah? So that goes up, and that's your final cash balance. It actually went up from 2,50,000 to 3,20,000. All right, now let's make sure we have done everything. Revenue came in, we have added that to our cash balance. We had these two expenses, we have subtracted that from our cash balance. We had these two depreciations, we have depreciated that, so the new value of the asset is that. So yeah, looks like we are pretty much covered. Yeah. So let's go here and do the same thing. We try to reconcile the difference. What is the starting cash balance in August? Is 2.5 lakhs. So we are again going to see, how did this 2.5 lakhs become 3,20,000? The first thing we do is you add your operating income. That is, cash coming in from your revenue net of your expenses. And then, did we have any depreciation? Yes, we had some depreciation. We're going to add that back for the same reasons we did the previous month, non-cash expense. Okay, did we have any capex? Did we spend money on capex? No, not really, right? And actually, to make this a little more sophisticated, you remember capex is an investing activity. It's a separate category of a balance sheet called investing activity, whereas all these are not all those actually. This one is called operating activities. All right, there you go. You remember that. And there's a third category called financing activity, but we are not going to get into that right now. All right, so where were we? 2,50,000 in cash. Your operating income has come in. You've added back your depreciation, non-cash expense. What else do you need to do? Has your capex, the value has gone down because of depreciation that you've accounted for here. Then nothing else has happened really. So now let's see what our ending cash balance according to our statement is. It is 3,20,000. Bingo! You see the 3,20,000 number is the same as the 3,20,000 number here in the balance sheet, and the cash flow statement just did its work once again. It told you how you're spending your cash every month. Now let's do one more transaction. Right? Let's say in the month of August itself, you took a loan. Okay, you took a loan to expand your business. You took a loan for 2 lakhs. So what happens if you take a loan? You took a loan of the liabilities. So what is the compensating adjustment on the asset? Because you took a loan, you got cash from a bank for 2 lakhs. So your ending cash balance goes up by this 2 lakhs, right? You took a loan, the ending cash balance goes up by 2 lakhs. So now your ending cash balance is 5,20,000, but there's a mismatch here, right? So taking a loan is a financing activity. So you go to financing activity, take loan, and you say it's an inflow of cash, so it's positive, plus 2 lakhs, and there we are back again. These things tally. 5,20,000, 5,20,000. Should we try to do one more transaction maybe? Let's say in August you got cash revenue of 2 lakhs, and let's say you actually got accounts receivables of 1 lakh. What that really means is that you recognized revenue for 3 lakhs, but out of that you got cash for only 1 lakh, right? So this is where is this accounted? This is not cash, so your cash balance here does not go up. So what really happens? On your asset column, you actually add a new account saying accounts receivable and add this 1 lakh to that. And there you go. You have your accounts receivable, which is 1 lakh because of this amount right here. But now, because your revenue actually went up by 1 lakh, because accounts receivable, your total revenue is actually 3 lakhs, but 2 lakhs of that is cash. 1 lakh of that is in you'll get paid next month. So your operating income should go up, right? It's going to be the 2 lakhs plus the 3 lakhs. So your operating income went up by 1,61,667. So that, because we link these things together, this automatically increased the operating income increase. But now something has happened, is that here the ending balance for the cash says 5,20,000, whereas our cash flow statement says 6,20,000. That is because this 1 lakh increment is not affecting the cash here, so this cash is not going up. However, since we added that as part of the operating income, our operating income actually went up. So we need to take that 1 lakh out of the cash flow statement, because that is not really cash coming into that company. So what you're going to say here is add a line saying change in accounts receivables. All right, since this is money that you would have otherwise got and that you didn't actually get, it's going to be minus the 1 lakh. There we go again. 5,20,000, 5,20,000. It balances, and there you go. That is your 3-statement financial model. Now you are going to be rock solid. There's really very little more you need to know in how to build or analyze a model. Once you get this right, you can just do this for any company, almost every scenario, and you're on your way. All right. Thank you very much for taking time. I will see you soon.